Could Americans be affected by the massive revenge tax on foreigners? Absolutely. And the investment implications could be significant for everyone. So you're probably asking yourself, how can I figure out whether this will affect me without spending hours diving into a tax bill that was so big and boring that even some of the people who voted to pass it didn't actually read it? That's what this video is here for. I'm Ethan, CFA charter holder, investment professional, and make things simple specialist, so to speak. Today, I'm going to break down in simple, plain English what is the revenge tax, how it could impact different types of investments you might own, and what you can do to avoid it, or even profit from it. Ready? Let's dive in. Here's the simple version of what's happening. The House passed a bill that's being dubbed as the revenge tax, which would raise taxes that most foreigners pay on U.S. assets. Not all U.S. assets, though. Probably. It's full of vagaries like you see below. It says it doesn't apply to portfolio interest, which typically includes interest on U.S. Treasuries, as an example. Well, I typically don't do a lot of things that I sometimes do, so this doesn't exactly inspire confidence. It also seems like it wouldn't impact capital gains, as in when someone buys an investment and then sells it for a profit, but it does seem likely to impact things like dividend-paying stocks, rents, royalties, some interest payments, and even real estate capital gains. So, this brings up a few key questions. Which foreigners will pay? How can this affect U.S. investors if it's only a tax on foreigners? Why would they even do this? And what can you do about it? Answering those four questions will be the remainder of this video. So, which countries pay? In short, pretty much all of them. They say only, quote, discriminatory foreign countries with unfair foreign taxes. And I highlight the legal wording here in case you really want to go through it, but I wouldn't waste your time. Remember how when Trump launched his, quote, reciprocal tariffs, he actually charged countries significantly more than what they were charging us by basically using a formula that had nothing at all to do with the actual tariffs on U.S. goods? Well, I would just say that we shouldn't take anything off the table. A, quote, foreign tax might not be a tax at all. It could be a non-tariff barrier like different food quality standards. Who knows? The main point is that it could be really wide-ranging. But this leads us to the next question. If it's only a tax on foreigners, how would it affect U.S.-based investors? Well, the prices of investments, like everything else, are driven by supply and demand. Foreign investors own about $60 trillion of U.S. assets. If they start selling out of some of those, the prices will go down. And if you own some of those same U.S. assets, like stocks, bonds, mutual funds, ETFs, etc., the value of your investments will go down because of all of that selling. Mass foreign selling of U.S. assets can also weaken the dollar, which would make imports more expensive, aka boosting inflation. And if the selling extends to bonds too, it can make it more expensive to borrow. That means higher interest rates on things like mortgages, car loans, or basically any other kind of loan. Now, you may be thinking, that doesn't sound very good, so why would they do that? I think for one of two reasons, or possibly both. First, some people in the U.S. administration think that foreigners invest too much money in the United States, which strengthens the dollar, thus making our exports less competitive, and that's why we don't have as many manufacturing jobs as we used to. Almost every economist in the world would find this argument to be insane, but some people in the administration believe it, and they make the rules. So a policy like this could actually happen. The real reason we have fewer manufacturing jobs in the U.S. than we did 50 years ago is because we have been thriving so much as a country that our wages have gone up a lot, and now we're able to do better, higher paying, less labor-intensive jobs. You can make a lot more money designing new iPhones at Apple's headquarters in California than you can by physically putting iPhones together at a factory in China. I don't know a single person who would want to switch roles. So, reason number one is that their convoluted logic makes them believe that it would bring manufacturing jobs back to the US. Reason number two is that it could simply be a negotiating tactic. One of the things other governments have talked about as a response to tariffs is a digital services tax, almost like a tariff on US tech companies. Right now, the US administration is really focused on the trade deficit, but what they really mean by that is the goods trade deficit. We buy more physical things from other countries than they buy from us. But the US actually has a massive trade surplus in services, meaning other countries buy more services from us than we buy from them. That's things like Google Maps or Instagram or WhatsApp or Netflix. Other countries have recently considered stepping up or implementing new digital services taxes in retaliation for tariffs. He might be using this rule as a negotiating tactic to stop them from doing that. This bill has passed the House, but it still has not yet passed the Senate, so a lot still remains to be determined. But in the meantime, what can you do about it? Well, the simplest answer is invest more outside the United States. If some of those $60 trillion of foreign money that's invested in the US assets leaves, even if it's just 1% of it, that is a huge amount of money leaving the US and going to other countries. All else equal, that means lower stock and bond prices in the US and higher ones outside the US. It also means a weaker dollar, which would boost the returns for non US investments. Obviously, there are other things besides this that can move asset prices, and there's still a ton of uncertainty about when, if, and how it might be enacted. But if it's enacted at all, regardless of the form or timing, it would be very likely to lead to an exodus of money out of US investments and subsequently into non US ones, which, all else equal, would be bad for US investments and good for non US ones. This is not advice, it's just education, but if all my investments were in US assets right now, I would be pretty nervous. As someone who is already well diversified geographically, this is just the kind of thing that I don't have to worry about as much. What might hurt one side of my portfolio could also help the other side, which is why it generally makes sense to remain diversified. If you found this video helpful, hit the like button, hit the subscribe button, and leave us a comment to let us know what you'd like us to cover next. And if you want to connect with my partner Kyle and I directly, you can do so by joining our free Discord with over 500 members through the link below in the description.